Hey everyone, Michael Reynolds here, Elevation Financial. I'm trying something new. I'm going to start combining my Facebook Lives with my podcast recording. This episode is meant to go live tomorrow if you're watching it today, which is Tuesday. But I'm going to go ahead and combine them and do them at once. So we'll see how this goes. So we'll kick things off here right now. Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining me today. Glad you are here. So as I kind of mentioned in the live before I hit record on the podcast episode, I'm trying something new today. We'll see how this goes. I'm going to hopefully do this going forward. I'm going to combine my Facebook live broadcast with my podcast recording. So what that means is I record these generally on a Tuesday, these podcast episodes, and I publish them on Wednesday morning, usually around 5 a.m. So it's kind of ready to go when everybody's waking up. So that's my schedule. So I'm going to start broadcasting the recording session via Facebook Live. That way you can, if you want to, you can watch, you can get access to it via video. I need to get some captions going on these as well, so it's more accessible. But in general, I thought it'd be a good way to create more of a multi-channel approach to the podcast episodes. So if you like video better, if you just want to watch a video on Facebook as opposed to listening to the podcast episode, you can follow my Facebook page, which is Elevation Financial on Facebook. Or if you're watching this live and you want to get it via podcast, you can do that too. So that's on multiple channels. I'll put it on YouTube as well. So I'm using an app called StreamYard. I like StreamYard quite a bit so far. It seems to be a really good platform for broadcasting to multiple channels, and it has some nice graphic effects too. So if anyone is into live broadcasts or live streaming, check out StreamYard. It seems to be a good one. StreamYard.com. So with that, let's jump into the topic today. So today I want to talk about why is my friend's investment account doing better than mine? This has been asked by more than one person I've talked to in general, sort of a thing we see happening sometimes. We're always looking for, the best return on investments. And, we don't really talk about this a whole lot, I don't think, with friends and family, but often you'll hear people say, well, my investment's doing really well, or my 401k is really up this year by X% or whatever, or wow, my investment account's doing awesome. And, people sometimes talk about this. They might be bragging. They might just be kind of bringing it up. And it kind of poses the question, why do some people's accounts do better than others? You might be thinking, well, my friend says they're getting X% return, and I'm looking at my account and I'm not getting that same rate of return. I'm getting something lower, or maybe even negative while they're positive or something. So that can be frustrating. It can be stressful. It can be kind of make you think, well, what's going on? What's wrong with what I'm doing? And so I wanted to address that today and talk about that concern of, hey, why is someone else's investment account doing better than mine, perhaps? So again, it can be kind of confusing, but we want to think about this in terms of investing goals. Investing goals are not one size fits all. What's right for you might not be right for someone else, and vice versa. So investing is not a one size fits all type of thing. Some people, generalize it a bit, and there are some general principles you can follow, and there are lots of experts you can listen to that say, hey, do this one thing and this is right for everybody. And there's controversy on that. My opinion is it's not right for everybody. There's always unique situations. There's lots of common situations as well. Lots of common threads you'll see among investing with different people, but also you want to be sure you're thinking of investing as something personal to you. It's not one size fits all. There are many factors that go into this. So think about that in terms of your investing goals. We'll talk about that in a minute as well, but just think about the fact that someone else's investing goals are likely or could be different than your investing goals, which might lead to, in the short term, a difference in the performance or the behavior of that account or that investment. So there are different methodologies as well. So when people are setting up investment strategies, maybe they're DIYing it, maybe they're working with a financial advisor, someone like me or someone else who's helping them with this. They have approaches to their investment strategy. Some people might read a book and say, oh, well, I'm going to do it this way. Some people might listen to a financial expert and say, well, I'm going to do it like so-and-so says to do it. Or some people might say, well, I've just heard that this is the right way to invest. And they listen to a podcast episode and they do it this way. That's one way people kind of approach their investing strategy. Others do a lot of research. They might do a lot of research into how investing works and mutual funds and ETFs and stocks and bonds. And they might come up with their own strategy based on that. Others work with a financial advisor and get some professional help in designing an approach that works well for them. So within that, you're going to have different methodologies and different ways that investments behave. So on one end, for example, there's something called value investing. There's also growth investing, growth stocks. There's also just tracking an index. Different people have different opinions on the different ways these types of investments perform. So someone, for example, is doing growth investing. They're likely going to be investing in funds that are full of growth stocks, companies that are on track for expectations of growth in the future. Others might be looking at value investing, which is investing in stocks and investments where the companies are thought to be undervalued. Maybe their actual price they're trading at is lower than what their true valuation might be. They also might just be tracking an index. They might just be saying, you know what, I'm not going to bother trying to, pick a strategy necessarily when it comes to the specific investment. I'm going to just track the S&P 500, or I'm going to track, just the various indexes and buy passive index funds. There's no right or wrong. It depends on kind of what your approach is. So one example of this. So let's look at value versus growth stocks versus value stocks. So there has, over the course of decades that we've had data to track this stuff, there is no one clear winner across the entire time period. Sometimes value investing beats growth. Sometimes growth investing beats value. Recently, for example, in the current climate, growth appears to be doing better than value. However, in previous climates, value was doing better than growth, and there's a trade-off back and forth across different time periods. So you're never going to see this consistent, predictable, always, like I said, always predictable way to see what the future holds. If you could do that, then investing would be super easy and everybody would be rich. But that's not how it works, obviously. You can't necessarily see or you can't predict future returns based on past behavior necessarily, although past behavior has shown us that inconsistency is kind of the norm. You sometimes see certain investments do better. Other times you'll see them doing worse than comparable or other types of investments that you might look at. So in general, you're going to have different methodologies, different types of investments or funds will perform differently. You have to take that into account. Doesn't mean there's a right or wrong. It also means that, again, going back to different investment goals, different people have different reasons for the way they invest. So someone that's more aggressive, for example, let's take someone who has a long time horizon. They're more aggressive. They maybe have 30 years to save and invest before it's time for financial independence or retirement. At that point, they might be an extremely aggressive investment. It might be tilted toward a lot of volatility, highly aggressive. It might end up in the short term. It might appear to be giving greater returns in the short term. Other people might have a more modest kind of growth, balanced, lower volatility approach, maybe because their attitude or their perspective on investing is different. They don't want to see volatility. Maybe they have the same time horizon, or maybe they have a shorter time horizon, but they're going to be able to withstand less volatility. They want less ups and downs or fewer ups and downs. They want a smoother ride. Other people might have really conservative goals. They have a short time horizon. Maybe they want conservative investments that are much more less volatile or much more stable. Others might have different accounts for different purposes. Some people might say, you know what, I'm going to have a long-term account for retirement or financial independence. I'm going to have a medium-term account for things like near future purchases, 5 to 10 years out. And I'm going to have another account for 2 to 3 years out purchases. Is going to be really conservative, and depending on which account you're looking at or which investment mix you're looking at, you're likely going to see differences in performance there. And so there's so many factors that go into just saying, well, why is my friend's investment account doing better than mine? And they're doing something better. Not necessarily. That type of thinking encourages very short-term thinking, which we want to avoid. We want to make sure that we are investing with the attitude of, hey, I'm going to do what's right for me, my time horizon, my attitudes, my perspective toward investing, my appetite for the volatility, and for the goals I have for the account. You can have multiple different types of accounts that have different purposes and different investment strategies within them as well. So it's not just as simple as saying, well, so-and-so's investments are doing better. Maybe they are, maybe they aren't. Maybe there's more risk as well that involved. And so part of the goal of investment strategy is to manage risk as well. It's not just about squeezing out a bunch of returns. You might be seeing returns squeezed out in a big way in a short-term period. But over the long term, you might see a totally different behavior. You might see that over time, when you aggregate the returns over time, you're going to see a much different story. So managing risk is an important consideration when you're building investments. So you want to say, well, I'm tilting toward an aggressive mix. I'm tilting toward aggressive investments, but is my risk being managed? Am I also protecting the potential for loss? That's something you want to look at. So again, immediate performance is not everything. If you're looking at someone else's performance and it's in the short term and it looks really good, that's just one slice of the entire spectrum of what's going to be happening in the lifetime of this account or this investment. You can't take what's happening this month as cause for concern necessarily. So the important thing is when you're planning your investments is that you are looking at your time horizon for the specific goals you have. You're looking at who you are as a person, your mix in terms of your financial facts about your life. What's the objective facts about your life? What is your attitude toward risk as well? What are the subjective facts about how you perceive investing? Those are all important things to take into account. So I wouldn't get too hung up on comparing your investment performance with someone else's. That, again, leads to short-term thinking. It leads to really, honestly, just stress that's unnecessary. The important thing is that you are intentional about what you're investing in. You're intentional about how you have structured your investments. If you're doing it with intention, if you have reasons for it, whether you're DIYing it, whether you're doing your own research, whether you're working with a professional, the point is that you are paying attention, that you are being intentional, that you are intentionally choosing with help the investments that make sense for you. So I wouldn't get hung up on comparing investments with someone else. Don't compare performance. Make sure you do what's right for you is kind of my bottom line message there. So again, if you're watching this live or if you watch this after the fact as a recording, let me know what you thought. Let me know how it turned out, if it works well for you, or if you like the podcast versus the live, or if you'd like both, kind of how the technology worked for me as well. I want to see if it's working well for everyone who's listening. So with that, thanks for listening, especially during my episode that's kind of an experiment with live streaming. I appreciate you joining me today. Thanks for being a listener. As always, you can reach me on the web at elevationfinancial.com. Excuse me. And you can book a meeting there if you'd like to chat. If you're not a client yet and you'd like to just ask a few questions, use that button on the homepage that says book a complimentary money session, and I'd be happy to chat. Thanks for joining me today. Till next time, have a great day. See you then.